Good morning, everyone. Campbell McCreary, Amvest Capital, New York City. Welcome to the Amvest Capital live webinar with Vimy Resources Limited. Vimy trades on the ASX as VMY and as VMRSF on the OTCQB. That would be Victor, Mike, Rio, Sierra, Foxtrot. Hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of GoToWebinar or send them in, email them in, and either way, we'll ask them in real time. Amvest is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Please note this call is most definitely for informational purposes only. Pleased to have with us today Mike Young, who is the Managing Director and CEO of Vimy, a geologist by background, experience in base metals, iron ore, uranium, and gold, and a strong focus on mine camp exploration, resource definition, and mine development. Some other names of companies that he's been involved with include Bannerman, Cassini, and BC Iron. Of note, a few years ago, Mike was appointed as the Uranium Forum Chairman of the Minerals Council of Australia. Very good. Mike, if you want to share your screen and turn on your webcam.
There's my webcam. I'll just get the, hi everybody from Australia. I'm just getting the screen going. Please bear with me for a second. Here we go. Right. So this is about Vimy Resources. Right now, it is the time for uranium. The place is Australia, and the metal, obviously, well, it's time for nuclear, and the metal is uranium. Global sentiment is certainly moving towards nuclear energy. It's rapidly evolving quite quickly. I might say I've been very surprised. I've been in the nuclear industry on and off since 1981 when I was in university. The investor sentiment towards uranium companies is actually booming. Demand growth for uranium is increasing with power increasing, but there's a supply lag, and I'll talk about this. Vimy has a significant deposit at Mulga Rock and a significant deposit pipeline, and we have a team that will deliver long-term sustainable value. So from an ESG standpoint, which is becoming very important, particularly in the green economy, uranium is central to clean energy. So Mulga Rock has the potential to offset 64 million tons of CO2, which is 41% of New York State's total greenhouse gas emissions in 2018. So that's how much uranium will produce. It'll fuel about 8 gigawatts of power. In terms of environmental stewardship, the way that we plan to mine on site is it's basically a flat-lying deposit, which will allow us to return our overburden, which sits over the ore, into the pit voids behind us. So we call this real-time rehabilitation. And really importantly, our tailings, so this is the product that comes out of the mill that produces the uranium concentrate, those tailings will go into pit voids, so there will be underground tailings facilities. That's pretty rare to do that, but what it means is that you eliminate surface discharge risk, and it is absolutely world's best practice. So when the tailings facilities are full, we then cover them with clay and topsoil, and when the mine is rehabilitated, they are basically out of sight, out of mind. Also, we have maintained continuous engagement with the Aboriginal people since 2010, but the area we're working in is called the Yellow Sand Plain of the Great Victoria Desert. No one lived there. The nearest habitation is 220 kilometers away, which is about 170 miles. Risk of disturbing archaeological or anthropological sites, which again is something else that's becoming very local. And our intent is to, the city of Kalgoorlie Boulders, the nearest town, major mining center in Western Australia, and we intend to buy local and hire local. So what an amazing quarter we've had with respect to uranium equities. Anyone watching this space would have noticed that we've had a mini boom, and a lot of that can be sheeted home to America. You know, when Biden was elected, he committed America to the Paris Accord. Biden and Kerry have both come out strongly supporting nuclear power. And this is important because nuclear power is 20% of US's electricity, and it's 55% of their clean electricity, followed by hydro and wind on about 17%, and solar, which is a long way back. So nuclear is very important to America, both strategically as a power source, but also in America's goals to hit net neutral by 2050. So you're not going to do it without nuclear, and I think the whole world's waking up to that. In the European Union, the experts are saying that nuclear power qualifies for green investment. So this is really important with respect to tax and tax breaks. So what we can see around the world is that nuclear is becoming rapidly becoming in vogue. And as I said before, I've been amazed, frankly, at just how quickly it's happened. The underlying thematics for uranium continue. We're seeing shrinking supply, increasing demand. The utilities are still sitting on the sidelines. They're not getting into the market in a big way. The leading indicators are at historic highs. So this is conversion and enrichment. So when you look at uranium, uranium has to go through a fuel cycle. It goes through a conversion process. It goes through enrichment. We're hearing a lot about enrichment with Iran, but that's a different kettle of fish. And then it goes through fuel fabrication, and those processes, the downstream processes, are separate markets that have their own spot prices, and those prices are moving up. So that's a really important leading indicator. So despite the fact all these equities have gone, ballistic, we just haven't seen a huge change in the spot price, and I'll come to that in a minute. So this graph's a bit complex, but I'll just break it down. So this is a report that came out by Shaw Partners in 30th of November 2020. They picked some Australian uranium companies. What they did was they charted what they think the share price should be for different uranium prices. So along the bottom, you've got $30, $40, Shaw's estimate for the startup price, $50, $60, and $70. So you can see the price rises. So the black line at the bottom shows the price at that time and the price today. And what this shows you is that a lot of our peers are now fully valued, whereas Vimy down here in the bottom right, we're not. We've had good share price recovery since November. We got picked up in coverage in March, and our share price hasn't risen to anywhere near our peer values. So Shaw and Partners had a 27-cent price on Vimy. Again, if you look at some other metrics, peer metrics, this is enterprise value, which is, for those of you out there who don't know what that is, it's your market capitalization. You throw in debt, which we have zero of, and you debt off cash, and that's your enterprise value. And then we divide that by the net asset value of the project. And you can see, again, Vimy is relatively undervalued compared to our peers. Again, enterprise value to your resources and reserves. And again, Vimy comes in quite low. So the point here is that Vimy as a share to buy in the market, there's a lot of upside leverage. There's some of our peers like Boss Energy are fully priced. Uranium supply and demand. So this is really a complex area because there's not a lot of visibility on it. These are from the World Nuclear Association. Now, if you're interested in data and you're interested in facts and you're interested in all things nuclear, there's a fantastic website, which is world-nuclear.org. It's the World Nuclear Association website, and it has an amazing library. Every 2 years, a fuel report comes out. Some of our employees are authors of that report. We have a very strong presence with the World Nuclear Association, so it gives us a very deep inside knowledge. These charts, the top one shows demand growth, growing from the current 392 gigawatts to 569 by 2040. And most of that is going to come out of East Asia and the Middle East. So the OECD countries, which is Europe, Canada, Australia, and America, new builds are very rare. We've got Southern building Vogtle 3 and 4, but by and large, the new builds are very rare. Most of the new builds around the world are happening in China, the Middle East, and Asia. And that's simply because these are big, expensive things to build. And when you're building them in democratic nations, what happens is you have election cycles, and the people who get elected want to retrofit things to a major infrastructure project, and that just leads to delays. But in the non-OECD countries, that isn't such a big problem. But what is happening in America is the development of small modular reactor and micro modular reactor technology, and this is being supported by Bill Gates, several private enterprises. Now, the Americans, you've had small modular reactors for a long, long time. They're in the ships and they're in the submarines. This is not new technology. This is very safe and proven technology, and I think this is going to be the real growth for nuclear going forward towards the end of the decade. On the supply side, what we're seeing is on this graph, we just show primary production, secondary production, and what we call idle capacity. You can see that these things are dropping away as mines reach the end of their life, and there's a big supply gap between the reference case and production, and I'll talk a little bit more about that. We call the supply shortage again musical chairs. So the utilities, who are basically the only customer for uranium, they are dancing around the chairs. There's fewer and fewer chairs. It's very hard to build these chairs. It's hard to bring a new mine into development. And all the while, we're seeing increasing demand. Nuclear power growth is expected to be 52% by 2040, which is fairly significant. Major mines are closing. Ranger is closed. Cominac is closed. Ranger being in the Northern Territory of Australia. Cominac in Niger in Africa. That's about 7 million pounds have come out of the market. COVID has disrupted supply, particularly in 2020. We saw 60 million pounds come out of the market during 2020. And to put that into context, the entire global consumption of uranium is about 180 million pounds. So that was a pretty significant knockback. Most uranium production is not profitable at current spot prices, but the reason they are profitable is they're supported by long-term contracts. And I'll talk a bit more about that. So we're seeing a systemic uranium shortage going forward, and this is the opportunity for backers of Vimy. So this is the history of uranium pricing going from 2004 to present day. There's two lines on the graph, spot and contract. You can see that since Fukushima in 2011, and in the center left, the prices have drifted down. So what that's meant is there's been not a lot of exploration and development of new projects. And what that's done is that has actually created a shortage that we're heading into. Vimy has been, I've been with Vimy since 2013. And while the price has drifted downwards, we have developed the project and pushed it along so that we are ready to go when the uranium market increases and flips up again, which is it's going to occur relatively soon. This is a consensus view. So it's a collection of different companies, BMO, Raymond James, looking at where they think the spot price will go. Quite a wide cloud of data. It kind of looks like climate modeling, to be frank. So no one has a crystal ball, but the bars in the middle are the median or the 50th percentile of this data. And you'll notice on this graph, there's always this gap between the contract price and the spot price, and that is what we call arbitrage, and that's how the spot traders make their money. They buy spot material cheaply, and then they sell it into contract. And that gap has always been around 22%. So if we take the spot price that's being predicted by the various banks and investment houses, and we make that correction for 22%, this is what it looks like. So these are very healthy prices, you know, $60, $63. Those are the sorts of prices that are needed to incentivize new production. So Vimy, who are we? We're a Western Australian company based in Perth. I'm Canadian by birth, but I've been living here for 35 years. My background is I'm a geologist, and I moved towards resource geology very early on in my career. So I've spent a lot of time looking at projects as a consultant, bringing feasibility studies and mines into development. And then in 2006, I joined a company called BC Iron. We listed in December 2006. We had no office, no staff, no work had been done on the project. We started drilling within 4 months, and 4 years later, we were exporting iron ore. So we moved this company from a $25 million placement to a $600 million company by the time I left. Shell Edwards, our chairman, is an ex-government minister, very experienced in approvals, which is one of the reasons we brought her on board. And I want to talk about Scott Hyman. Now, Scott's actually online, but he's got audio problems, so I'm hoping he's working on those because I'm going to bring him on in a little while. Scott is a uranium sales and marketing specialist. He worked with Dominion Energy for about 17 years, and he worked with Cameco. So he's been on the buy side and the sell side. And Scott has very deep and long-term relationships with the people in the U.S. utility industry. So Scott and I spend a lot of time before COVID face-to-face, and since COVID on Zoom, talking to the utilities. And my experience is that Scott has very deep and meaningful relationships with the utilities. And this is what has allowed us to develop very good intelligence as to how the utilities think, and to ensure that we are at the front of mind for these utilities when they start writing contracts. And around it out, Julian Tapp, he's what I call our Chief Nuclear Officer. He's our dog's body, so he does approvals. He does a lot of high-level marketing work. He's also the chair of the supply working group for the World Nuclear Association. So we are very involved in the industry. We're currently in a trading halt, raising money, so that cash position will change on Monday. We've got 778 million shares on issue. Major shareholders include Paradise Investment Management, very large fund in Sydney, a listed fund. Forrest Family Investments, so that's owned by a man named Andrew Forrest, who owns Fortescue Metals Group, a major iron ore company in Western Australia. And then we have a very large retail base, and I might just add that directors and staff do participate in a salary sacrifice scheme that we have, where we give up part of our salary in exchange for shares. And as I was saying before, we had this this equities boom, but the price hasn't moved, and you can see that quite clearly in our share price graph. We have two big projects. The major project is Mulga Rock in Western Australia. It's about 800 kilometers from Perth, or 500 miles. It is accessible by road. It's a 90 million pound resource with a 42 million pound ore reserve. About another 20 million pounds of that resource we expect to be mined, which would give us a 15 to 20 year mine life. The net present value for the company is 400 US pre-tax with an IRR of 31%, payback period of less than 3 years, which is pretty significant. And our costs are very low. All-in sustaining costs is $28 for the first 5 years, where we're mining higher grade material, and $31 life of mine. We have state and federal conditional approvals. I'll talk a little bit more about that in a second. But basically, we're moving through our secondary permits as well. So that's like the mining permit, the mine closure plan, all the the building permits you need to get the project going. We also have a second project in the Northern Territory in the far north of Australia called Alligator River. This is a large tenement area with multiple high-grade targets, and another resource called Angularly, which is actually quite high grade at 1.3%. Mulga Rock is very simple. It's an old river channel that's actually silted in and filled in. At Mulga Rock, we have the study level is DFS and a DFS update. We have the tenure, which is our mining leases. That's all done. Permitting is a long way along. So compared to a lot of our peers, we're very advanced. It's high grade compared to a lot of our peers. So it's not high grade like Saskatchewan, but it's a high grade deposit in context. It has very simple geology, mining, metallurgy, which is low risk. And we have dug 2 test pits, which are these photographs in the slides. And we know that this is free digging. So what does that mean? That means we don't do drill and blast, which is it just adds costs and makes life a bit more difficult. It allows us to be highly selective in ore mining, so we minimize ore loss and dilution, which is important. And as I said previously, we can dump the tailings and waste into the pit voids. In terms of processing, it's a very simple off-the-shelf process. It's sulfur acid, leach, and resin pulp. This is normal processing for uranium. We did a pilot plant, and there's just no risk on the processing. That's one of our test pits, just showing some of the geology. And this is the pilot plant that we built back in 2017, and producing our own yellow cake. In terms of the project metrics, as I spoke about before, 3.5 million pounds a year for a 15-year mine life. We think we could add another 20 to that. And we also have base metals. So that's nickel, copper, zinc, cobalt. In the deposit, they don't come out in uranium, so they don't contaminate the uranium product. But we are able to extract them after the uranium stream, and they would actually reduce our costs by $4 to $4.50 a pound. So this is a graphic that just shows the all-in cost of production for mines around the world from left to right as the price increases. And what this shows you is that on an all-in sustaining cost basis, Vimy is very competitive. So this isn't a matter of if this mine will get up, it's a matter of when. How do we do that? Well, basically, we have completed the DFS refresh in base metal, the original base metal assessment. Secondary approvals are moving along. We expect those by 30th of June. The key thing is contracts. So this is a contract market. Uranium does not have an open market like the London Metal Exchange or gold. You have to have a contract with the utility. We are concentrating on the US. They are 28% of the global market. They are low counterparty risk. We could get long-lived contracts with US utilities.
That would then allow us to, sorry, I'm just getting a notice on here. Bear with me, sorry. Oh, sorry. I was just getting, sorry about that. I've had to dive out of, the program was, sorry guys.
You just press your present PowerPoint back.
Oh yeah, sorry, yeah. All right, we're back on.
Yeah, your video and audio is all good. I think if you just switch back to the presentations page.
Yep, sorry about that. Perfect. So, yep, I was just, sorry about that. The program was just giving me a warning for some reason, so I don't know why. So, so as I was saying, once you get contracts, it allows you to get debt funding, spelled lead wrong there. It's contract led debt funding. And then once you have debt funding, you can get your equity. Now, because this is a contract market, allow us to really leverage up on the debt. So we'll have a lot more debt than you normally would have. It's a 2-year build from FID through to mine opening. Alligator River, Northern Territory. This is the home to some large deposits. The land holding we have is quite large. So what I've done here is I've superimposed the land holding on a map of the Athabasca Basin. So just to remind you guys, the Athabasca Basin is home to some of the largest and richest uranium mines in the world. And the Alligator River province also has some rich mines at Ranger and Jabiluka. So our properties, we bought those from Cameco. We have one more payment to Cameco next year. But this is a very rich underexplored area. Target rich, we've got the Angularity deposit, we've got several other targets. The exploration potential is huge. We plan to do some work there this year. But we do have options on this. We could actually do very low cost exploration. We could advance Angularity with some drilling, add proximal resource pounds, or we could look at partnerships, joint ventures, and even spin the project out. This graphic's really important because what this shows you is it shows you the exploration history of Canada versus Australia and the Alligator River province. So from left to right, you go from 1970 to 2018. In Canada, they were discovering these large deposits, were getting deeper, and recently they discovered Arrow and Triple R and Rough Rider. Whereas in Australia, we had a policy came out through the federal government, which no longer exists, called the 3 Mines Uranium Policy, and that just meant that there was no exploration. So we have a large land holding in a very prospective area that has had no modern day exploration. So what's Vimy going to do in 21? Well, we are keeping our team uranium boom ready. We maintain a very strong presence. We are doing some early work on Mulga Rock later this year, so the last half of the calendar year. We do prioritize and manage our spending. We have shares in lieu of salary and part-time employment. We are looking at the operations, optimizing the CapEx and the OpEx for the project. And lastly, with funding, as I said, it's a contract-led model. It's dominated by the US because they're a big part of the global market and 80% of what we call the accessible market. That will lead to debt funding, which will maximize leverage and minimize dilution. So The investment opportunity is basically there's been a shift in sentiment short term. Nuclear is definitely needed to save the world. We're seeing a lot of FOMO, fear of missing out, which is driving prices. But the comparable metrics for Vimy are much better than a lot of our peers, which means that the upside opportunity still exists. And then when the uranium price starts to move up, you'll get that second surge because we're one of very few companies who will actually be in production in the first half of this decade. Long term, we'll shift from sentiment to fundamental driven through the uranium shortage. We have a good asset with a great team. Scotty Hyman's working on customers. That leads to production, sustained capital growth. So tide's coming in, all the boats are rising, but you always want to back the boat that will sail away, and that really is Vimy Resources. So I've whipped through that quite quickly, Stu. I might leave it there, and happy to take questions.
Excellent. And
Scott,
we want to bring Scott on.
Yeah, Scott, if you're there and your speaker's working, maybe we'll bring you in and introduce you to everyone who's listening.
Yeah, just unmute your audio there.
Okay, can everybody hear me?
Yeah,
Okay.
perfect.
Yeah,
Excellent.
that's better.
Oh, Mark, if you want to get your presentation up again, that'd be good.
Yeah, so introduce Scott. So Scott joined us 3 years ago, and Scott does our marketing. So he's based in Minneapolis and Florida. So he's currently, I think you're still in Florida, aren't you, Scotty?
That's correct.
Yeah.
And
so
Mike, you want to share your screen and
Bring the PowerPoint back up, Mike, then we can.
Sure, I could do that.
okay. So please, everyone, send in your questions. We have some already.
I think if you go back, there you go.
Could you clarify the requirements needed by the government 16th December deadline? How do you plan to achieve these and the consequences of not doing so?
Sure. So going back to this, so what we have with our ministerial approval from the WA state government, there is a condition on that approval which says that, which was issued to us in December 2016. We have to have started work on the project by within 5 years. So part of the use of funds for the raise that we just did is in fact to commence early works on the project. Now, the condition in the ministerial approval is this: we start work, we then provide documented evidence to the government in a letter to the CEO of the Department of Water and Environmental Regulation that we have started work, and by doing that, we have satisfied the condition. The ministerial approval has no provision in it for the government to contest our view that we've started. And furthermore, the WA state government, the anti-nuclear part of the WA state government is a very small group. The leadership group, including the Premier, the Environment Minister, the Mines Minister, are not anti-nuclear. And so we are very confident that the work that we plan to do will satisfy the condition. Now, if the government chooses to contest it, obviously that won't be good for us, but we believe that the risk of that happening is very low.
Okay, thank you. Can you compare the uranium spot price needed for your project with the other projects available in the industry? Where do you stand?
Sure. So I don't have all the metrics for all of the different companies. I know that Paladin would like to see a 50. I know that when you listen to Cameco, they talk about having a 4 handle in front of their deposit. So if you look at the Shawn partners here for some of our other peers, which is Paladin, Boss, Bannerman, Peninsula, Lotus, and ourselves. Shaws believe that Paladin needs somewhere between 40 and 50. Same as Boss, between 40 and 50. They've got us at about 50. Bannerman's at just over 40. Peninsula is around 40 to 50. So there's a constant theme here. You know, a lot of projects need a $50 price to get up and running. A lot of the newer projects, and interestingly, Bannerman probably needs a much higher price. I think Bannerman's used a $60 price, $65 price in their DFS. We've also in this presentation, which I might just go to the very back, we've done some work on some of our other peers with this graphic. So this just shows the study phase and the uranium price that they're needed. So Bannerman says they need 65, Berkeley's at 70, Deep Yellow's at 65, Fission's at 50, Forest is 65, and Goviek's at 55. So these are metrics that have come from these various companies' studies. So, you know, the constant theme is that to bring new production online, and there's very few new mines out there. There's very few projects that are being developed, and there's certainly not at the level that these projects are at. And the projects, you know, they've all got 5s and 6s in front of them. So the price has to move to these numbers for there to be enough uranium in the world to supply the growth, well, the existing reactors plus the growth that's coming.
Okay. COVID. How has COVID generally affected your uranium production numbers? What is the biggest impact?
Yeah, well, the biggest impact was Kazatomprom in Kazakhstan and Cameco. So Cameco shut down Cigar Lake soon after COVID started, and Kazatomprom shut down their well development. So that was at a time when both companies and the globe really didn't know how to handle it. So there was a very, very strong prevalence to shutting down. We're very lucky in Australia. We managed to stop inbound traffic back in February 2020. That means that the operations in Australia didn't stop. During 2020, there was about 60 million pounds of uranium came out of the market. So we mined about 120 million pounds and burned 180. Now, because of the nuclear fuel cycle and the way that there's quite a long time delay between 3 and 5 years between mining the material and then actually going into the core of a reactor, you don't see an immediate effect of that, but that effect will be felt in a couple of years when the shortage starts to bite.
Okay. Maybe we can pull out our crystal ball and discuss more the uranium price. Scott, what are you seeing these days?
Yeah, so hopefully you can hear me okay, and I apologize for previous audio.
Yeah,
but
well.
Okay, great, thanks. Yeah, you know, everybody wants to have that clear picture, the clear crystal ball. You know, right now it's I would say it's an inventory-driven market versus a production-driven, simply because there was oversupply for a number of years. And, you know, but that's being drawn down both on the utility side and on the supplier side. So, you know, over the past year, we've had some COVID impacts, of course, on markets and market price behavior, but it hasn't been solely on that. You know, here recently we've seen, you know, some producers or emerging producers purchasing on the market, sopping up some of the perceived spot overhang. So, you know, the market is always a bit fickle, and right now it's holding right around $30 on the spot market. You know, with a little upward and downward ticks.
Okay. So,
thanks for presentations, you know, Mark and Scott. If you could touch on, Mark, maybe Australia's uranium mine policy, and you know what government approvals are still pending for Vimy and those steps going forward.
Yeah, sure. So we don't require any more ministerial approvals. So ministers are what you would be in America. There would be secretaries of the various departments. So we don't require those high-level approvals. The approvals we still are working on are the sorts of things like building approvals is the best way to think of it. And those are done at departmental levels. So we just work through with the bureaucrats. Anyone who has worked with bureaucrats know they love to ask lots of questions. So we're just working through that. We'd expect to have those approvals by June. We will certainly have the approvals that we need for the early works by June, and then the approvals for the entire deposit should come through during the remainder of the year. The timetable, as I said, we would hope to be writing contracts this year and moving into funding by the end of this year into early next year. And then making a financial investment decision on the project sometime in early to mid 22 with a 2-year build. So all those approvals will certainly be in place long before we need to start operations.
Right. And then,
and so I'll just go back to the 3 mines policy. So that's a legacy policy that doesn't exist anymore. Just for your viewers or listeners out there, Australia has a very bizarre voting system where if you're not the winner, you can then allocate your votes to another party. And so there's lots of deal making that goes on. And so during the 80s, a deal was made between the Labor Party, which would be probably the left wing of the Democrats, and the Greens, which would be the left wing of everything. And so what they did was they made a deal so they could share votes and came up with this 3 mines uranium policy. That's since been struck down back in the 90s, and neither major political party in Australia is opposed to uranium mining. And in fact, it's been really good that the Democrats in America have shifted to a pro-uranium stance, because what that has done is that has really shifted a lot of center-left parties around the world to really, look at the science, look at what needs to be done if people want to reach these greenhouse gas targets and adopt nuclear energy.
Yeah, I think one positive for Vimy is having Scott, because I from our research into it, Vimy is probably the only developer with a sales and marketing person in the US who used to work at the utilities. That's
a really good point, Stuart. And we met Scott at one of the uranium conferences. And when we first went, we really were a fish out of water, and Scott was one of the first people to come over and say hello. You've met Scott. He's a really wonderful guy. But what has amazed me is the depth of his knowledge and his relationship with the U.S. utilities. So what's important is, once you move into the nuclear industry, there's really nowhere else to go. So the guys in the industry have been there for a long, long time, and Scott knows all the guys. Scott, maybe it's worth just having a quick chat about some of the meetings that we've had recently, particularly with some of the companies are starting to ask really specific questions about volumes and timing, but maybe discuss more generally how much work we do with utilities.
Yeah, thanks. I did want to just offer up some general comments to follow up the crystal ball discussion. Look, in this business, nuclear is a fairly tight industry. As Mike mentioned, folks have been in their positions or with their companies sometimes for a number of years, but it is relationship driven. Of course, that's been a bit challenged over the last year, no doubt, not just in nuclear, but across the globe. But look, utilities generally want to contract up to 80-90% of their contract holdings via long-term contracts. Yes, they play and dabble in the spot market to fill some relatively small open requirements, but for the main part, they want to lock in contracts that cover 3 to 5 and perhaps even longer years. And they have open requirements that are coming up that are really in our wheelhouse for the time that we're looking to come on and bring in production at Mulga Rock. So it meshes quite nicely. And some of the comments that we're getting from utilities, not just recently, but over the years, is, you know, they look and they prefer supply and supplier diversity. And, you know, with that, you know, Mike mentioned there's been a couple of mines that have come offline, one, of course, in Australia. So the limitations on Australian origins are, you know, very known, and not all utilities, you know, have that. So they'd like to diversify, and we, of course, can bring that opportunity to them. They're very supportive of new production. You know, we try to keep them well educated with the advancements that we're doing both at Mulga Rock and our pipeline projects at Alligator River. And that really resonates with them, that a company like Vimy, we're not just kind of a one and done, that we're actually got some other projects in the pipeline. So, you know, that's another thing that in the nuclear industry, it's very long-term looking. Visions are very long. Fuel cycles are long. Some of these plants are going to be operating at least into the 2050s, 2060s. And, you know, they're looking for long-term sustainability.
Yeah, great. Thanks for that. And then I think some people up here might be used to seeing projects in the Athabasca Basin and those grades. So maybe if you could quickly touch on Alligator River and how it's analogous to some of the, you know, geological history of the Athabasca Basin.
Yeah, sure. So that one graphic I showed here, while that is a diagrammatic graphic of the two basins in terms of history, it does show the geology. So the geology of the two areas, the Athabasca Basin and the Alligator River, is basically you've got this basin of sandstone sitting above this crystalline rock, and the deposits tend to form either below that boundary, which we call an unconformity. So they're called unconformity deposits, very imaginative, or they occur at the boundary. And so that's the model we're using. We have one of the big differences, anybody who actually knows about the Athabasca Basin, is that the rock is very incompetent. It's very soft and full of water. And so at Cigar Lake and McArthur River, they actually have to freeze the rock and freeze their surrounding area before they can actually drill and blast it. We don't have that problem in the Alligator River province. The rock's very competent. There was a mine called Nabralek, which was mined underground, which is a good model for our angularly deposit. And in looking at our targets, you know, we've got targets which look like McArthur River. We've got targets which look like Jabiluka, and, you know, we barely scratched the surface. So, you know, this is a really important project for us in terms of going forward, just because it gives us that optionality.
Thanks for that. I'll pass on to Artie.
Thank you. How comfortable are you with your estimated economics when you consider the amount of data you have collected so far and the work you have done so far?
So the economics at Mulga Rock, we have done an amazing amount of work. There's a really quite impressive DFS was put out in 2018. You know, during the DFS study, we did an incredible amount of work, particularly physical work on the mining. So one of our biggest operating costs, 42% of our operating costs, is mining, because we have a 10-to-1 strip ratio. So we decided to build 2 test pits for about $2 million. And what we found was that the mining risk is very low. The mining costs are very predictable. We used a company in Western Australia called P&Satini, who are experts in sand mining, and so we then de-risked the mining. In terms of metallurgy, likewise, we collected 100 tons of ore and we trucked it to Perth. And we were so thorough with the test work project in our pilot plant that we also trucked 2 tons of process water from our bore field down to Perth rather than using tap water. So normally what would happen is when you are doing a pilot plant in Perth, you would just make up the water, chemicals in the water that you expect to occur on site. But we were actually so thorough, we actually trucked the water down. And the other thing we did is, while these tanks are relatively small, they're 6 feet high. The tanks on site will be between 10 and 15 meters high. And what we did was we duplicated those tanks by having 1 meter wide, 15 meter high columns to assess the effect of hydraulic head. So it was a very, very thorough pilot plant and a very, very thorough test pit. So we're very confident about the numbers for the project.
Thank you.
Hey, Mike, could I just add to that that we did send samples to the 3 Western converters for sampling and analysis work, and it passed all their requirements, and so we know that it satisfies the conversion facility requirements. So that's important for the utilities to know that.
Sure is. Yep.
Thank you. Scott, so you mentioned the utilities, they look for long-term sustainability. I want to ask, when do you think the uranium market see more contracts, and what can be a macro catalyst for that?
Scotty.
Yeah, that sounds like an easy question, but it has a very difficult answer. But look, the contract period, no doubt, has been affected for the past year, as has everything else with COVID. Utilities tended to take a more inward view, especially like the chief nuclear officers, the CNOs of the companies, and being more concerned with ongoing operations and operating safely and getting people in and out of there safely. So along with that, utilities were facing a bit of a issue with revenue streams that were not what they were thinking they would be. So largely they tightened the belt on expenses, whether it was expenses that were today or out in the future. So I think that caused a bit of a pause, but requirements, open requirements are still out there, as I mentioned before, and they're coming in that 23, 24 and onward time frame. And utilities generally start to look at that, filling those open requirements 2 to 3 years in advance. So we're kind of right there at the cusp of them doing so. And we're seeing some, long-term market activity. I guess it's just a matter of, when is it gonna, the ball is started to roll. When does it pick up some speed? And, from the discussions I have and from other industry reporters out there, that's going to happen as we move on into 2021. So that's kind of the vibe right now.
Thank you. Campbell?
Sure. 2 more questions that have been sent in. Thank you very much. A long-term shareholder asks more detail for use of funds from your capital raising activities.
Yep. So the use of funds will be to commence early works at Mulga Rock to satisfy that last condition in the ministerial statement. And then we have some discretionary some discussion on doing exploration in the Northern Territory. So we certainly have to do the minimum work required to meet our expenditure commitments. We also are going to do a bit of work on a group of tenements which lie to the northeast of Mulga Rock. So the Mulga Rock deposit, as I outlined, does contain base metals. We have zinc, copper, nickel, and cobalt, and the base metals are have come from another source. And we believe it's to the northeast of the mine. We've pegged 150 kilometers of tenements. We've put that into a subsidiary called Vimy Resources. We haven't, for the last few years, done any work on it, partly because all the tenements weren't granted and partly because of COVID. But we would like to do some project generation work on that. That would just be relatively cheap geophysics, airborne geophysics. We also want to do some work in Alligator River. As I said, that might include some drilling on some of those targets, some infill drilling angularly, and then working capital. So what we would really like is, and what we have, is to have a very strong balance sheet. And by that, I mean the ability to wait for the contracts to come to us. So what will happen as the contract market improves is the utilities will do what I call walking up the cost curve. So if we look at the cost curve here, what happens is that the cheaper producers will bid into contracts early. They'll write $30 contracts, and then suddenly people will start writing $40 contracts and then $50 contracts. Now that means that you need to wait. You need to be strategic. You don't want to go into the contract market too early and be writing contracts where you're not making a whole lot of money. The project is very sensitive to uranium price. So if you look at this graphic, basically it drops 180 million pounds, $180 million Australian, which is about 100 million US for every $5 change in uranium price. So it's really important to have the ability to be strategic. I think anyone paying attention to Ian Purdy at Paladin will hear the same message. Certainly, it's a message that resonates with our shareholders, and that is we would, we'll have the working capital, we'll have the buffer that will allow us to write very strategic contracts to ensure that we capitalize on the value of the project.
Last question: will contracts likely be linked to spot, so we'll move with the uranium price?
I will let Scott answer that because he is our contract guy.
And then, and adding to that, we'll be looking for contracts outside of the U.S. So, and then we'll close.
Let me answer that first question. And go ahead, Scott.
No, go.
Yeah, so the philosophy is to really concentrate on the US. As I said, it's 28% of the market, but about 80% of the open market, or the market available to us. France is the next biggest user, and China. The Chinese source the material from Asia and from their own operations. And France, EDF source the material from existing producers, but we believe that once we start writing contracts, EDF may revisit that. And then you've got the various European players. They're actually pretty small compared to the US. So we do concentrate on the US. And the second thing I've mentioned previously is that the US does represent a low counterparty risk, but I'll let Scott talk about the nature of the contracts we plan to write.
So, Campbell, if I understand your question, like the time frame of contracts, is that
will the contracts be linked to the spot price?
Oh, sorry. No, for base loading, Mulga Rock, our focus is going to be on more so on, say, fixed or base escalated pricing mechanisms. Some of it's dictated by what the utility is looking for. They like diversity of price mechanisms as well. But look, we're going to be for the early days anyway, we're going to be focused on trying to maintain that base number that we're going to need to get the project going.
Yeah, and that's, I mean, I think the listener's question is related to if we see a real surge in the spot price. So it's important for your viewers to understand that we will have a large part of our offtake base loaded, and by that I mean it'll be at prices that are predictable, because that allows the financiers to come in and give us the money with confidence. But not all of the offtake will be on fixed contracts. We do expect to see, the tail end of our offtake. We would like to leave some exposure to the spot market so that the investor has exposure to that. So the investor with Vimy will have exposure to both the spot price, but also exploration success in the Northern Territory. And it's always really good to remember that we're not a one-trick pony. We have the Northern Territory, which could generate multiple deposits for us, and really generate some really exciting exploration results going forward.
Okay. Thank you everyone for tuning in and for your questions. Please share your feedback on your way out. You'll be queued for that. And the event will be available in about an hour you can get catch the recording at amvestcapital.com/webinars. With that, I'll bump it back to you to close. And I always ask, why buy the stock now? So.
It's leverage. I mean, we're still, you look at the peer figures on any metric, Vimy's still undervalued. Now, anyone playing CEO bingo will say bingo. That's what the CEO is supposed to say. But if you actually look at the metrics on the graphs I've presented, and you look at some of the research that's out there, some of our peers are fully priced, whereas Vimy is still underpriced, undervalued on almost every metric.
Excellent. Thank you too, both, and have a great rest of your day. Bye now. Thank you.
Thank you.
Thanks.
Thank you.